Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So, a lot of talk about the government shutdown, and it looks like it might happen, but it also looks like if history is any guide, it likely won't matter too much for stocks. Profit margins, we've just come off a really strong Q2 corporate earnings season. Expected profit margins for S&P 500 up near all-time highs. And then also, when we look at overall trends and momentum, we've seen some selling to end the week here after a really strong third quarter. There are a lot of stocks and a lot of industries that are in uptrends right now. So every year, Congress has to come together to approve budget spending for 12 different appropriation committees. And if they don't do it, the government shut down. And if you go back to 1976, there have been 20 years where it has shut down. The good news is those shutdowns typically only last 8 days. The most recent one was actually back in 2019, about 5, 6 years ago. That was the longest one ever. But if you recall, only 25% of the government was shut down, but it was shut down for 34 days. Federal workers typically continue to go to work. These are all non-essential items that are not getting paid, if you will, as they call them, and they get back pay when they come back. Not a good look for the government, but when you talk about the length of them lasting, they typically don't last that long, and sometimes it's a negotiating tool for one side or the other. Now, what does it mean for the markets? And history tells us probably not much. If you look at during these shutdowns historically, the returns are pretty mixed overall. If you just look at the last five, the returns are actually positive during these government shutdowns. The truth is, they don't really have a large impact because number one, they don't last that long. Number two, everybody thinks they're going to be funded at some point, and history is a guide. It's usually in about 8 days. And they're back paid. Stocks or investors are typically looking at things like trends, corporate earnings, economic, bigger long-term trends than this mismanagement by Washington over the overall stock market. Now, looking at profit margins, we've had a lot of talk about the labor market slowing, but when you look at corporate earnings, we had a really strong Q2 earnings. Look at expected profit margins over the next 12 months for the S&P 500 companies. They're up to 18.24%. They've been a little over 12%, in fact, in double digits during the last 3 quarters of earnings. We've had double digits earnings. So corporate earnings have been really strong. Expectations is for that to continue. What that means for overall labor market, I think is interesting because you have definitely seen the labor market stagnate. The unemployment rate still only at 4.3%, but to the extent that companies have these healthy profit margins and strong earnings growth, that could insulate and create support from any real meaningful layoffs in the labor market. So slowing of hiring, absolutely. But this could insulate further damage in the labor market for the US economy. Now, trends are really strong. Obviously, the third quarter has been really strong. This week's been a little bit of profit taking here. But when you just take a step back and look at all the S&P 500 industry groups here, one popular way to measure how many stocks are in long-term uptrends is the percentage of stocks that are above their 200-day moving average, just a real long-term back of the envelope measure. And as you look at all the industries, we can see a couple things. Number one, the majority of most industries have more than half their stocks in uptrends. That's a good thing. That's broad participation. As we look at what industries are looking really good in terms of that breadth, we have automobiles, banks, you see semiconductors, tech hardware, media and entertainment. So some of these communication services, some of the technology sectors, mega cap tech, those things like that, as well as banks. These have really good participation during this rally. And what's not doing as well, that's on the far right side. You have pharma, biotech, life sciences, food and beverage, tobacco, personal products, especially those last two. Those are going to be a little more defensive in nature. And we're seeing defense take a back seat to risk on growth right now. Large cap growth's doing good. Small cap stocks are doing good. They like the fact that rates are moving lower and corporate earnings are still strong. And these are the winners that we're seeing in the market so far this year. Now, speaking of winners, a lot of talk about large cap growth, mega cap, Mag 7, all this stuff. Well, Warner Brothers Discovery, old Warner Brothers, Roger Rabbit, Warner Brothers Discovery is up the most of any stock in the S&P 500, up nearly 70%. I think it was about 67 last I looked just a few moments ago. On rumors of Paramount Skydance. Remember, that's the company of the Ellison family. They are eyeing an acquisition at Warner Brothers. So it hasn't been official, but some potential large mergers in the media space that is sending Warner Brothers Discovery up a significant amount during the September. We'll see if that cash acquisition goes through in the fourth quarter of this year as potentially rumored. With that, I want to thank everyone for watching, and I'll see you next time.